I will shift on to our next panelist. This is for Mr. Prakash Sinha. So the first question to you goes like this. Prakash, looking at through the legal and financial lens, Section 514 of the Income Tax Act 2025, fully operationalized through the Income Tax Act Rules 2026, creates a highly prescriptive compliance environment with independent registers, rigid slab fee structure, severe disciplinary parameters, etc. Simultaneously, the Corporate Amendment Bill 2026 seeks to crown IBBI as the apex regulatory authority for valuers. If the JPC aggressively pushes a single regulator model in the name of ease of doing business, can a corporate law amendment legally dilute, bypass, or override, as Sir said, independent revenue protecting assessment powers granted to sovereign tax authorities? How should the JPC structurally reconcile this profound jurisdictional tug of war? This is my question to you, sir.
Shall I come there?
Whichever you are comfortable, sir.
I will come. First of all, thank you for providing me an opportunity to be part of this panel here, elite panel here. It's really an opportunity to deliberate this matter here. Second, with a deep regard to Mr. Dubey, I would like to say that some of the black sheep does not make the ICI as a black sheep here. So one or two cases may be there, but does not make that does not dilute the reputation of the ICI. Being a chartered accountant, then an advocate, my heart is a chartered accountant, then an advocate. My mind is an advocate, but heart is a chartered accountant here. So it is with due regard, nothing to refrain to anything here. Now coming to the question here, which has been posed to me. The question is that, whether there should be a unified regulatory authority or not here. Apart from the present scenario here, about the income tax or like this one here, if you see, under the present scenario also, we have the Income Tax Act, we have the Custom Act also. If the material is imported, there is a different value that has to be applied for the purpose of valuation purpose under Section 14 of the Customs Act here. Under the Income Tax Act, different valuation method is there. The purpose of under the Custom Act is to maximize the custom duty, maximize the value of the custom duty, whereas the purpose under the Income Tax Act is to get the best tax from the efficient tax from the transaction here. So the purpose of each of the valuation is different. When the object and purpose of each of the valuation is different, then we have to understand the law from that object and perspective. Like under Section 514 of the Income Tax Act, this law talks about the valuation under the mechanism for the purpose of deriving the tax from the SSC here. It is a tax law, so the purpose is to derive the best tax from the SSC. And wherever, like under the Income Tax Act, you have the fair market value. Under the transfer pricing, it is the case of the where between the associated party, it is the arm's length value is derived here. So under the income tax law also, there is no uniformity. It is a different terminology that has been used here. So my first point is that why we need an uniformity. Second is that each of the purpose and object of the law is something different. Under the Income Tax Act, the purpose is to collect the best tax from the SSC, so there is a mechanism is there. Come to under the proposed corporate law amendment here, which gives a detailed guidelines. This guideline is much on a different object here. This guidelines is that because in a corporate law, the trust is imposed on the valuer that wherever the pricing system is required here, that pricing system should be at a price where some investor can come, investor can acquire, investor can do it here, like in the case of where suppose take a case of that. If Indian company is issuing the share to its foreign holding company, you can say that there is a guidelines under the FEMA which talks about that the value has to be used for the purpose of discounted cash flow method here, one of the valuation. Under the Income Tax Act, there is a different method that has to be that here. Under the company law, there can be different method here. So, when I talk about under the FEMA, since it is a foreign exchange transaction here, the government wants to get a maximum foreign exchange here. So they says that the share value should not be the value lesser than the value which has been derived from the discounted cash flow method here. This is the purpose under the FEMA. Under the income tax, purpose is to achieve where the fair market value is there, where the market value is there, different terms, sometimes assessable value is there, sometimes annual value is there, different purpose, different law, different purpose. Come to the new proposed law. So the purpose of the new proposed law is much wider than the tax law. Tax law is qua the revenue, whereas IBC, this is the proposed law, is qua the public at large. Public at large means investor, all the type of stakeholder, governments, valuation, which rightly you have raised the issue of the SARFAESI. In many cases where the loan gets NPA and the there is auction takes place here, then the valuer rule come into play. The purpose is that the bank should recover its NPA and bank should be able to recover that his money here. It is not the bank should able to make the profit of that part here, because it's someone property, some person property is getting deprived for this purpose here. So the purpose is something different here. Therefore, if I go to the conclusion here, I do not think that JPC will say that whatever the purpose that is there under the Income Tax Act, that should be taken over by the IBBI. IBBI may be the valuation authority under the new proposed company law, but the purpose of the new company law is something different. It is qua the investor, qua the purpose. It is a much larger value than the tax value, where the tax authority is for the purpose of collecting the tax. So I was just discussing in one of the issues here, just like we say that we have the right in rem and right in personam. These are two things very much important. When you create a value under that part here, under the new in corporate law, you have the right across the whole world here. So it is a more type of this, that's a right in rem that is there here. The person who is doing a value is much more responsible into this part here. For the purpose of income tax here, you have to do certain value. What the government is say that. So what will happen? Just take a consequences here. Consequences is much harsher in the new proposed law. Income tax does not say that if your valuation is wrong, I will remove you. If you go to the consequences like this one here, income tax does not. Income tax says that yes, you will qualify certain exams. After that, qualifying certain exams, you will become a valuer. And after that, you have to do the value. And after that, there will be assessment, regular inquiry that will be. There is no harsher provision. But in the case of the where your responsibility as a valuer is much more wider, the power has been given to the valuation, this IBBI, to go through all this part here, even if they can suspend the license also. And much moreover, they have been given the duty to develop the guidelines, to develop the policy, to develop the standards of the valuation here. So The pricing, though, I think the IBBI is a much broader, on the much broader footstep here, whereas the income tax is only for the purpose of collection of tax. It is a much in a different perspective here. And therefore, my understanding is that there is no need of the unified regulatory authority for this purpose here. Purpose is something different. Thank you.